Stock buybacks. What are they? What do they do? And why am I interested in them? So, before I dive into this very niche topic that is stock buybacks, I want to first paint a high level picture of the point of business and the stock market. So, the point of the stock market is for a company to raise money. Essentially, what a company wants to do is they want to offer ownership of their company to the public in order for them to raise money for their next business ventures. And this is a good thing because it allows for them to not get too much into debt to continue their business operations and keep growing. They can now exchange their own equity or their ownership in their company as a way to raise funds and really also just get a better idea of what the valuation of their company is. And the way companies represent ownership within them is through something called shares. Shares are it's just like a unit, but whenever you see a stock price saying like, oh, Amazon is worth $100, Apple's worth $200, that represents one share, one unit of ownership. So when a company is initially growing, they usually get money via loans from venture capitalists or private investors or whoever. It could be their mom, their dad, it doesn't really matter. But at a certain point, they don't want to take on any more debt. Instead, they want to actually raise money by offering ownership within their company. And that's what it means to go public. I want to now offer ownership of my company to the public people in order to raise money. And the public, it can be just like, people like yourself or myself, retail investors, people putting money in their 401k, or all those people at Wall Street. And so once you go public, that is when you see all these different charts with the lines going up and down here and there. Let's look at the NASDAQ. Basically, the idea is that with all these different eyes upon you now and all these different players invested within your company, there is more transparency. Well, I mean, that's like a legal requirement, but there's just so much more activity involved with your company trying to value it at the appropriate price. And that's what it means to go public. It means I am trying to raise money, but now I'm getting a better idea of the true valuation of what my company represents. Well, at least that's how it's supposed to work. It's supposed to be like, okay, I have more legal requirements to divulge information about how things are with my company and yada, yada, yada. So the market should be able to appropriately evaluate what it's worth. But that's not just reality. Um, Sometimes reality is different than what you expect it to be. And so let's backpedal one more time. I want to explain the role of business. Actually, let me just explain like what businesses do. So businesses make money. um, Let me pull this up real quick. So the goal of a business is to make money, potentially make yourself rich, but also to provide a service. And one common thing that people think is the idea of maximizing shareholder value. That means that once you have a share within our company, once we've gone public, or whoever has a share in the company, my goal is to make you money because you have trusted me with your money. So the idea is to return value to you. You give me money, so I'm going to give you back money later. And so how that works is basically you have a business and I don't know. They create revenue, right? Revenue is what you get when it's just the total amount of dollars based upon the things you sell as a company. But so that's that's the top part. After that are the expenses, and that could be things like cost of goods sold, which is the expenses that are generated from, whatever it is that you're making and selling. You can pay things like wages. Um, there's also taxes, and I think this is the big one. Interest, that's money you pay on your debt. But yeah, these are things that come out of the money you make. And what you're left with after is net income. So that is your profit. So just to go over one more time really quickly, revenue is the money you make. These are your expenses. And what you're left over with is your profit. So I'm a company, I have profit, and how do I return that to my shareholders? Or how do I return that to create a better business? That is the main question. And that's the whole point of this entire conversation. So let's go into that. So traditionally, if you have a profit or net income, businesses could really only use this to grow their business in three ways. You can either do it in one way, you can give more money to your employees, so reward them. You could actually pay out a dividend to the shareholders, so dividend. And that just basically means I'm giving every person that has a share in the company is getting a certain amount of money back. So you're getting direct payment for being an owner of the company. And the last one is you can reinvest it into your business. And that means like maybe you can buy some new equipment that can help you generate more money. You can do more research and development. You can do something in order to make your business grow. But in 1982, what they did is they released a new patch. Let's put this as 1982. And so what ended up happening was Ronald Reagan legalized something that was considered illegal called the stock buyback. And I'm just going to do it BB for short. And so just to sum it all up, one here is to pay the employees more. The other one is to reinvest into the business more. But here, dividends pay owners, and stock buybacks, what it essentially does is it is a way to increase the price of your share, which also pays back the owners. But there's a problem with the dividends. See, profit is money that's already come out of taxes. So this money's already been taxed before. But when you pay a dividend, the dividend payment gets taxed again. So you're getting taxed twice if you're trying to distribute dividends out of your net income or your profit. So rich people, they don't like really paying more than they need to, and they don't like paying taxes twice. I guess that's the mindset. So now let's get into the stock buyback. So the stock buyback. Why do companies repurchase their own shares, and is it good for investors? Essentially, what it means to repurchase your own shares is I want to use the cash I have in order to take shares off of the public stock market. The actual logic behind doing that is because I would say, oh, if my stock price seems a bit low, I can exchange my cash for a cheap stock. So if I think my stock's worth $20 and right now it's only selling for $10, it's a good deal for me to buy that stock back for $10 when I think it's worth $20. So that is the logic and that is the function of why stock buybacks are a good thing. But let me just start reading this article. It's stock buybacks. Why do companies repurchase their own shares and is it good for investors? This was published on August 28th, 2025 by James Royal. Anyways, so a stock buyback is when companies repurchases its own stock, reducing the total number of shares outstanding. In effect, it buybacks or reslice the pie of profits into fewer slices, giving more to remaining investors. A stock buyback is one of the major ways a company can use its cash, including investing in its operations, paying off debt, buying another company, and paying out the money as a dividend to the investor. So if I'm talking to an investor in my company, I'm thinking I can pay you a dividend directly. I can give you cash, but you own 1% of this company right now. What if I take some of the shares off the market? So now you own 2% of the company. If you own 2% of the company, that might be more worth it to you than me just giving you a couple bucks. If the company is worth, say, $100,000 and you own 1% of it, that's you own $1,000 in value. I could give you $50, or I can take off all these shares. Now you own 2%, and now you have $2,000 in value. It's something like that. I hope that makes sense, but that's the idea. So I guess the argument for the stock buyback is that method of creating value for somebody is more efficient than trying to deliver value or paying money back to somebody via dividends that gets taxed another time. The stock buyback doesn't get taxed the same way, and because of that, this is potentially more efficient. So this is an article from Sean Caston, who's a government representative, and his claim is that well, here's the article. It says there's a reason why stock buybacks used to be illegal. And if we go here, it says for most of the 20th century, stock buybacks were deemed illegal because they were thought to be a form of stock market manipulation. But since 1982, when they were essentially legalized by the Securities Exchange Commission, buybacks have become perhaps the most popular financial engineering tool in the C suite tool shed. And it's obvious why Wall Street loves them. Buying back company stock can inflate a company's share price and boost its earnings per share, metrics that often guide lucrative executive bonuses. That's an important one. As Reuters wrote recently, stock buybacks enrich the bosses even when the business sags. Well, so what are some of the critiques of the stock buyback? So if I go to the article, stock buybacks enrich the bosses even when the business sags, basically it says here, uh, when health insurer Humana Inc. reported worse than expected quarterly earnings in the late 2014, including a 21% drop in net income, it softened the blow by immediately telling investors it would make a $500 million share repurchase, or stock buyback. In addition to soothing shareholders, the surprise buyback benefited the company's senior executives. It added around 2 cents to the company's annual earnings per share, allowing Humana to surpass its $7.50 EPS target by a single cent and unlocking higher pay for top managers under terms of the company's compensation agreement. Thanks to Humana hitting that target, Chief Executive Officer Bruce Brossard earned a $1.68 million bonus for 2014. So, this company had a 21% drop in the profits they earned. But by using stock buybacks and the financial manipulation it has, apparently, it made the numbers look good so that the CEO can now hit his bonus target to earn him 1.68 million extra dollars. And in order to do that, by the way, this guy spent $500 million from his company to get a $2 million bonus. I mean, not even $2 million, but I mean, these are the numbers that we're looking at. This article here from Benzinga, Apple's $704 billion decade long buybacks exceed market cap of all but 13 companies worldwide. Tim Cook led Apple Inc. has amplified its shareholder value for several years with a robust share repurchase program, so much so that only 13 firms worldwide have a market cap higher than the shares that Apple has bought back. Basically, all that Apple is doing with their immense profits and their ability to print money essentially is they're just buying back shares of their company. And when you go back here, you're not, let's see, you're not giving your employees more money. You're not like spreading the wealth. You're not paying money directly to the people that own your stock, the shareholders. You're not reinvesting the money back into the company to like build something new or innovate in any type of way. I mean, the reason I picked Apple is because like, in what way has this company innovated since the passing of Steve Jobs? I mean, to me, it seems like Tim Cook's major innovation is by just using financial manipulation tactics in order to inflate the stock price. But like, what have they really done? And if I look up data center spending in 2025 by company, I mean, the top ones are Microsoft, Google, Amazon, and Meta. So all the big tech companies that are spending money on data centers don't include Apple. Apple's willing to spend $700 billion into the stock market to buy their stock. Yet these other tech companies are spending tons of money to compete in this data center. And by the way, I mean, is it like necessarily a good business decision to, invest in these data centers? Who knows? But the fact that Apple would rather not invest into something real and just like inflate their stock price, it begs the question like what is the purchase or what is the purpose of what you are trying to do? Are you going to reinvest into your employees? Are you going to pay money to the people, your actual shareholders? Are you going to reinvest in the business via getting into the AI race? Or are you just going to buy back more stock? I mean, and the thing about stock buybacks too is they create artificial demand for your company. The public stock market is supposed to put so many eyes and so much, availability of information into your company that's supposed to make it more efficient. The pricing is supposed to be more clear. But when rather than normal people buying into your company's stock because they think it's a good investment, it's the company itself that keeps buying it, keeping the price where it's at, making sure that the price keeps going up and up and up. I mean, we're not really even getting a fair reflection of the value of the company at that point. There's just better ways to like use your money to actually like do something real. I mean, given all this AI demand, we are having extreme energy concerns with the United States grid. And one solution to that is nuclear energy. So these data centers, they take a ton of energy consumption. And one of the best ways to resolve that is with something called a small modular reactor. It's just like a small nuclear power plant that's put next to a location. And that's something that we haven't really invested in at all. And given the energy demands of this data center thing that's going on within the country, the only companies that are actually really investing into it are Alphabet, Amazon, Meta, and Microsoft. But Apple, with all this money to spend, is nowhere to be found. So they don't spend any money on AI. They don't spend any money on data centers. The only thing they seem to be spending their money on is keeping their stock price up. Uh, I mean, is that really something that adds value to the world? So I want to explain a topic called human value added. I mean, this is something that's kind of in my own head, but I just want to explain it. So, like, let's just say you're somebody and you sell like wood for a living, right? And you sell wood, and then you sell it to a guy that makes chairs. So you sell it to some dude, and he turns it into a chair. Let's just say he bought the wood for $10. He put in whatever effort he did, and he sold the chair for $15. His human effort basically generated a positive $5 in value by turning this piece of wood into a chair. So like this is like real, you've created something, you've done something good, you built something. But like when you are spending, you know, what is it, $700 billion on like stock, like it makes it seem like I'm adding human value. It makes it seem like, oh yeah, I am producing some sort of something, but really you're not. I mean, I don't know. That's how I see it. It's human value added that doesn't really create anything at all. It doesn't really generate some sort of something of real value. And I think that's the problem. Like America is the richest country in the world, but they're doing all this financial fuckery to just make things look better than it really is because they're not really doing anything. I want you guys to watch this video from More Perfect Union real quickly.
Larry Ellison gave himself $100 billion? Well, not quite. Oracle's stock price shot up 40% last Wednesday, which made their CEO neck and neck with Elon Musk to be the wealthiest person in the world, largely due to stock buybacks. Oracle used stock buybacks to artificially inflate the price of their shares? No, the 40% spike was because of Oracle's quarterly projections, but stock buybacks over a longer period have inflated the company's share price, as well as taken Ellison from owning 22% of the company 15 years ago to owning 41% today. I thought buybacks were just when companies bought back their own stocks. Yeah, but it's also really important to understand what actually happens when a company does that. And to understand, you need to know that a company's shares can be split into two categories. There are the shares that are owned by the company, and then all of the other shares that aren't owned by the company are called outstanding shares. Why does that matter? Outstanding shares are used to calculate some very important things like earnings per share, which is the company's profit divided by outstanding shares. You're saying that when a company buys back shares, that's reducing the number of outstanding shares. Right. So if a company had $1 billion in profit and they had 1 million outstanding shares, their earnings per share would be $1,000. Is that good or bad? It doesn't matter. If the company bought back 200,000 of their 1 million outstanding shares, they're down to 800,000. They could have the same exact profit, but now it's $1 billion divided by 800,000. The earnings per share go from $1,000 to $1,250. The company looks like it's doing better without ever actually improving anything about the company or the consumer experience. And now people will spend more, which means that the share price goes up. But wouldn't that make it more expensive for Ellison to buy more shares for himself? But he doesn't need to, because ownership is also calculated based off of outstanding shares. 15 years ago, Oracle had 5 billion outstanding shares. Larry Ellison owned 1.2 billion of those. But Oracle has bought back 45% of their shares, which means they are down to 2.8 billion outstanding shares. So CEOs are using company profits to buy back company shares, which makes it look like the company is doing better, which means that the share price goes up. And since there are less shares in circulation, it's also consolidating CEOs' ownership over the company itself. A Palladino study found that from 2008 to 2018, non-finance related companies spent 75% of their profits on stock buybacks. This has to be one of those loopholes that the law just hasn't caught up with yet, right? Buybacks used to be illegal until Reagan's SEC legalized it in 1982. It's always Reagan.
I show you that video to say, like, what is the incentive for these people making the decisions to either, one, reinvest in your company. Oh, that's the wrong one. But one, reinvest in your company. Two, pay employees more. Three, pay out dividends to the owners. Or four, concentrate wealth using stock buybacks to hit your bonuses or make sure that you have more ownership within your company. Like, what for the people making these decisions, what is your incentive? So it says here, Larry Ellison's net worth is approximately 364 billion as of September 2025. Why net worth in terms of stock or whatever kind of matters is because these types of people, they don't function in the same way we do. They don't spend their actual dollars. What they do is they get loans and they use their net worth as collateral in order to basically, well, it's to avoid taxes. If this guy had to sell his shares of his company, he would have to pay taxes on those on that sale of stock. But if you take a loan, then you don't have to pay any taxes. Imagine you're buying a house, and I live in California. Let's say you're buying a house, it's $1 million. If I give you $1 million, would I ask you whoa, I just gave you $1 million? That's income. You just received some money. You should pay taxes on that. Well, the idea behind that is that you shouldn't pay taxes on a loan because a loan is used for you to kind of jump forward and make a purchase that you can't right now, but you will be able to over time. You shouldn't be paying taxes on $1 million loan. I mean, it's just crazy. If someone gave you $1 million to buy a house, what if you had to pay 35% in taxes? You can't find $350,000 out of your back pocket to pay in taxes. That's why the loan's a bit different. And that's this loaning function. The idea about the loan is how these people use their stock price and their net worth as a way to not sell their stock and avoid paying the taxes on that stock. And so now the goal for these people is to slowly increase their net worth. And one of those best ways to do that is via the stock buyback. Like, it's all about incentives. What is the incentive for a guy like Larry Ellison? What is the incentive for a guy like Elon Musk? What is the incentive for a guy that's trying to hit his bonus? The people making the decisions on where to spend the profits of a company, is it to distribute it fairly via the shareholders via dividends? Is it to give it more to the employees? Is it to reinvest it into things like nuclear reactors or data centers or something to create a better product? Or is it to spend money so that the rich get richer and the wealth is not equivalently divided? So do stock buybacks have an actual function? Yes, it does. You can potentially buy back your company's stock if it's undervalued, and in a way that does have value. But in practice, what it's used for is to concentrate wealth. These companies seem to have so much money that they don't know how to reinvest into their own business. And so what they do instead is they spend it on stock buybacks. And what does that do for society? Anyways, this is my research on stock buybacks. It's something I've been interested in for a while, but I would love to hear what you guys have to say about it. Um, I think that everything's a balancing act, and I think that we might have gone too far into the other direction, too far into the direction of extreme wealth accumulation to the point where it's no longer productive. Um, but I do want to hear your guys' voice upon this, so let me know what you guys think. And yeah, I'll see you in my next video.